Welcome to the Beehive Podcast, where insights buzz and growth happens. I'm William, and today we're diving into the numbers behind commercial real estate. If you're in real estate, your properties aren't just assets, they're financial ecosystems. Today, we're decoding the accounting that keeps them profitable. I'm joined by experts from Scrub's real estate accounting team, Leks Benitez and Karl Ochoa. Together, they oversee hundreds of properties and bring deep operational, technical, and strategic insights into CRE finance. Guys, welcome to the Beehive.
It's a very good day, and I'm very looking forward for this podcast to share with you our insights, Carolite insights on CRE or commercial real estate. How about you, Carl?
Yeah, actually, Lex, I am excited to have this podcast to share what we do in Scrub, the way we add value to our clients as part of the real estate team. And yeah, I'm excited to discuss a lot of things with you, Lex.
Nice, that's amazing to hear. All right, let's start off with a few warm-up questions, right? I want to know what first drew you to the world of real estate accounting.
Well, for me, real estate accounting wasn't love at first sight, really, but it was a fascinating intersection of numbers and impact. I started with an auditing firm, but real estate drew me in because every entry tells a story of ownership, value creation, and investment strategy. Over time, I came to appreciate how we, now as accountants can drive decisions, not just track them, especially in a sector as asset intensive and cyclical as CRE.
Yeah, and that's a great way to put it, Lex. The idea that every entry tells a story so powerful. It moves accounting from a back office function to a strategic tool. When you're in real estate, you're not just managing properties, you're managing financial ecosystem. And understanding that story is key to driving growth and creating value with our clients.
That's amazing. I feel like I'm talking to uh people who go host in TED Talks. You guys are amazing. So let's start off with the foundations of CRE, right? Which is cash flow and revenue. It kind of seems straightforward, but I think that commercial real estate makes it complex.
Absolutely. Many think net operating income or NOI, cash flow, and profitability are interchangeable, but they serve different strategic purposes. NOI reflects property level performance, basically income for financing and taxes. Cash flow counts for timing, when cash actually hits or leaves the bank account. Profitability is broader. It includes depreciation, interest, even overhead from the ownership. So in multi-asset portfolios, especially with staggered leases and financing layers, aligning cash flow projections with actual liquidity becomes critical.
So I think, Alex, that is a good distinction between these terminologies. It's easy to think that these terms as interchangeable, but in reality, they serve a different strategic purpose. So ignoring the differences between NOI and the actual cash flow is a common mistake that can lead to major liquidity issues, especially when you're trying to scale a portfolio. Each month, tenant billings are prepared and posted effectively on the first day of the following month. These billings are important because they serve as the source of revenue for the properties, covering items such as the base rent, the common area maintenance, real estate taxes, insurance, and utility recoveries. As property accountants, part of our role is to carefully review the draft billing batches before they are posted in the accounting system. We do this by comparing the current month charges to the following month's charges so we can quickly spot any unusual changes or discrepancies.
What is the biggest misconception about CRE cash flow right now?
I would say it's having that assumption that consistent rent equals consistent cash flow. This because rent schedules often include rent-free periods, straight line adjustments for gap, or escalation clauses. You may have accounting income on paper, but negative cash flow due to large capital expenditures or balloon payments.
And that is a huge takeaway for our listeners, Lex. Just because you have consistent rent on paper doesn't really mean that you have consistent cash flow. This really highlights the importance of having proactive approach to your numbers. You need to be able to forecast these fluctuations to manage your portfolio effectively.
Yeah, and then in managing those portfolios, as you mentioned, how do you manage revenue recognition across portfolios?
We use tools like Yardi, RealPage, or Appfolio, but tech isn't enough. You need scalable systems and processes. You also need standardized leads abstraction, consistent cutoff policies, and monthly reconciliations of AR to GL. Revenue recognition becomes even trickier when you're managing leasing commissions, tenant improvements, or early lease terminations.
And you're absolutely right, Lex, that technology is only as good as the processes behind it. Those standard lease abstractions and consistent cut-off policies are the unglamorous but essential groundwork. So it's easy to get caught up in the big platforms, but it sounds like the real magic happens in the day-to-day discipline.
Amazing. Amazing. All right. So I want to keep this podcast short. So let's move. I want to go on to our next segment and talk about a different thing, which is money held in trust, tenant deposits and escrow. What are the key accounting risks?
First, we must distinguish between secured deposits, prepaid rent, and escrow accounts. So basically, secured deposits, they are refundable, and so they are liability in nature. Prepaid rent, they are technically unearned revenue, while escrow accounts, they're often tied to taxes or insurance. The challenge is tracking them properly, especially when portfolios are large or are frequently changing hands. I've seen clients accidentally refund prepaid rent thinking it was a deposit, or they failed to reclassify deposits after the tenant moved out.
Let me stop you right there. What are some of the red flags during reviews or audits?
It's usually just misclassified entries, missing reconciliation between bank and subledger, or deposits recorded in GL but not traceable to these abstracts. One client I had over $100,000 in unclaimed deposits because no one was reviewing the aging schedule. So that's both a liability risk and a reputational issue.
And I agree with you, Lex, that those distinctions are so important. Mismanaging these funds is a huge liability. A simple misclassification can lead to legal issues or a loss of trust with tenants. As you have mentioned, I've also seen dollar amounts in unclaimed deposits because no one was reviewing the aging schedule. So this is not just an accounting detail, it is a customer relations and risk management issue.
Wow. So would you say that these problems are rampant in the US maybe? Or um is this something that companies may or may not have in the inside business?
It's more of it's I wouldn't say it's rampant. It's more of a usual oversight, and especially when smaller or medium-sized real estate businesses are scaling over or wanted to create a much larger portfolio. They usually don't look into this process checks. But again, we're saying that we need to have the systems and processes that are very scalable and make sure that before we scale those up, everything is correct in a simple subsystem or sub-process in its own.
And I think there is where we come in as professionals focusing on the real estate industry, that we are able to see items that are sometimes or most of the time overlooked by investors of property managers because they are focused on their core activities. So as scrum professionals, we are expected to know this nitty gritty, this detail in the financial statements to really inform the client of accurate reporting as well. Yeah.
Yeah. So it's just basically giving them the time to focus on what they're doing. Right. And you guys are focusing on the paper. All right. let's move on to another segment, which is CapEx versus repairs, right? On what gets capitalized, because it's a fine line, and definitely the IRS really cares about it.
You're right on that one. IRS definitely cares about those. Capital expenditures add value or extend the life of an asset. So they go to the balance sheet and get depreciated. Repairs, on the other hand, maintain the asset's current condition. So they go straight to expense. But the gray areas, like replacing on the portion or 30% of the roof, they create debates. So we help clients document the scope, the work to building systems, and even align with their in-house CTA for tax purposes.
Yeah, and that gray area is where having a clear, consistent policy is so valuable. Getting this right from the start is critical because it might impact your balance sheet, your tax liability, and ultimately your ability to accurately report on the value of these assets.
Yeah, but how do you ensure the consistency of that though?
It's always policy and documentation. So here at Scrub, we create CapEx review templates and flag items during invoice entry. Also, it usually helps involving the property manager early on because we often get clarification through work orders or vendor contracts.
And that is actually a great approach, right, Lex? So getting the property manager involved early is key, as they are the ones on the ground who can provide necessary context through work orders and contracts. So having those templates and flags during the invoice entry process, for example, creates a consistent and proactive system. It shows that you are not just reacting to expenses, but strategically managing them to ensure they are correctly classified every time.
Yeah. However, doesn't that like introduce less efficiency? Would you say? Like having those processes and policies would probably introduce some slowness in the process in the whole area itself. Or is that a worthwhile trade off for getting it correct?
You have to see it in a longer term. Sure, you see it in a short term that this is so hassle. Why do I have to document this? I already know this stuff. We don't need that documented on paper. But what we want to our clients to realize is that it is truly hard at first, especially when you're not into documentation. But this will especially be helpful when you are going to be delegating more work to your teammates or to your staff. That's because what we want is to ensure that everything is scalable at its own lower level. And that basically where you expand and generate more value with your systems.
And I agree with that, Lex. Actually, um, process documentation, these policies, actually, process documentations, training the team members are actually investments for us to be empowered to make or to provide more value adding information to the client. So we're not just focusing on the date of the invoices, the nature of the expenses, but we look at the bigger picture so that we are able to see the patterns in the past so that we can forecast in the future. So these documentations are essential for us to have sustained competitive advantage actually with the work we do. Yeah.
Carl, I want to hear more from you. Have you had any experience where policies or this process wasn't followed rigorously? And was there an issue that happened with that?
Yeah. So for my team, I ensure that we produce outputs with the utmost quality. All right. So that we are employing several review processes. So there is a junior accountant, and then someone would be able to peer review, or a reviewer will be able to double check the output of that junior accountant. With this kind of setup, we are ensuring that whatever we deliver to the clients, to the owners, the property managers, are with utmost quality. And I think quality is really the most important part of what we do in Scrub.
Yeah, but I want to learn if you have any experience throughout your whole career, as in CRE. Was there a time where a policy, when you were just starting out, did you ever see like someone not following a policy or uh something on that end that led to an issue happening?
Well, I think sometimes we have new clients. They are trying to build their portfolio, and sometimes they are the ones with, an organized, let's say, accounting system, right? So they do not have yet standardized processes, and again, that's where we come in as professionals focusing on the real estate. We provide them with valuable advice, with sample documentations of how we do it, and at some point they are able to follow it. The downside of having an organized accounting or for the startup businesses is sometimes they are not being focused on the daily entries, on the receivables, on the payables because they want to grow their portfolio. Right. So basically, there are sometimes instances where they miss paying the invoices. There are instances that the bank reconciliation does not match with the book records. So I think following policies or providing clients with proposals of how they will standardize their processes will also be useful, as Lex mentioned a while ago, in the long run.
So it does happen. It's not like it's an irregular thing, right? Okay. All right. So I want to move on to something that we call CAM or CAM reconciliation and recoverables. CAM fees necessary, but it's a little messy. I want to know what makes them so tricky.
They're tricky because recoverables like CM, taxes, insurance, they're often estimated. So they're billed monthly to the tenants. Then we reconcile them at year end. That's the best and usual practice. One missed invoice or miscoded expense, and your come through up becomes a 3 month headache.
And that's a great point, Lex, right? A 3-month headache is a perfect way to describe it. So these kinds of disputes or delays can sour a tenant relationship. The real lesson here is that clean, consistent inputs are essential for a smooth process and a positive tenant experience.
So, what's a common CAM billing mistake?
In my experience, it's usually misallocating shared costs like parking or lobby cleaning to tenants that don't benefit from those shared costs. Also, outdated lease clauses. If you're not aligning the lease with billing logic in your system, expect disputes with your tenants.
Yeah, personally, based on experience, a common CAM billing mistake is failing to accurately estimate a tenant's share of the operating expenses, which often results to overbilling. So this happens when a landlord or a property manager charges tenants a fixed estimated amount each month for a common area maintenance fees throughout the year. At the end of the year, we have a process called CAM reconciliation, which we perform through this task. We involve it involves actually comparing the total estimated amount billed to the tenant against their actual calculated share of expenses for that particular year. When the estimated amount billed is higher than the actual amount owed, it means that the tenant was overbilled, and this creates a credit that the property owner must then apply to the tenant's account.
So, how does tech help?
I love that in the tech that we use, everything is customized for the real estate client. So in Yardi, there's a module specifically for CAM to set up expense pools and allocation logic. But automation only works if your inputs are clean. Hence why we reconcile GL, we validate vendor mapping, and that's why we do mid-year mock reconciliation.
So, let's zoom in on fees, especially management and commissions. Is there anything that we'd like to open up about this?
Oh, sure. This may be small percentages, but over dozens of leases, they're material. For management fees, ensure the contract is clear. flat rate versus percentage of revenue versus adjusted revenue. Broker commissions also require clean tracking, especially with multi-payment schedules. For example, 50% upon signing or 50% upon occupancy. We advise our clients to use subledgers or CRM integrations to monitor their status.
And I love that you brought up the materiality of these small percentages, Lex. From a business perspective, these are material costs that can eat into your profitability if not managed correctly. The key is having a clear contract and a system to track it all so there are no surprises. So management fees are typically a percentage of a property's monthly rental income paid to a company for handling their day-to-day operations like rent collection and maintenance. Commissions, on the other hand, are usually a one-time fee paid to a broker for securing, for example, a new tenant or lease renewal. While both are expenses, their payment schedules differ. Management fees are generally paid monthly, whereas commissions are paid as a lump sum and often amortized over the lease term.
Wow. So what's the best way to reconcile commissions monthly?
The best way to do it is to have a separate tracker aligned with your general ledger or GL. Ideally, it's tied up to your list data as well. So we often automate reconciliation in Excel or use business intelligence dashboards or BI dashboards to catch duplicates or missed accruals. Also, don't forget commissions can be capitalized or expensed depending on the accounting treatment.
Yeah, and that's a perfect list, Lex. When you're trying to attract and retain investors, transparency and timeliness are your most valuable assets. A clean, well-structured reporting package not only reduces questions, but also builds that confidence and demonstrate that you have a firm grasp of the business. And the best way to reconcile commissions is to amortize them over the lease term. Instead of recording the full commission as an expense in a single month, you spread the cost cut over the life of the term of the lease term. This aligns the expense with the revenue generated from that lease over time, which provides a more accurate picture of the property's profitability each month. With this method, it ensures that we are accounting for the cost correctly and matching it to the financial benefit it provides.
All right. So you guys have done all this work, right? And made everything, ensure everything is quality and up to par, up to standards. Now let's talk about reporting. What do the owners and investors really care about?
They most definitely care about transparency, timeliness, and actionable insights. So here at Scrub, we report both fund and property levels. And our usual or key performance indicators include occupancy and vacancy trends. We also have debt service coverage ratio or DSCR. We have operating margins, cash on cash return, and unfunded capital obligations. A well-structured reporting package reduces investor questions and supports faster decision making.
And to add to that, Lex, I think owners and investors care most about accurate and timely reports that clearly show the property's financial health. They focus on key metrics like the net operating income, which measures profitability. And sometimes we use occupancy rate to measure performance or to indicate performance. It's crucial that reports are reconciled with any corporate level adjustments to provide a true and a consistent financial picture.
You see any pitfalls in distributions?
Of course, it's usually over distribution. Some clients base their distributions on book income or gut feel and not actual cash availability. We recommend setting up a cash waterfall and integrating it with cash flow forecast. Also, factor in CapEx reserves and debt covenants before doing the distribution.
And a major pitfall that I was able to observe is the delayed access to cash. Owners expect distributions right after reports are finalized, but this can be challenging. Common delays are caused by pending expenses, reserve requirements, or corporate adjustments that may affect the final cash position. Needing to wait for approvals can also hold up the process, creating a bottleneck between financial prudence and the owner's desire for timely returns.
All right. So to close things out, right? So this is the final straw. I want to talk about tech. There's a lot of tools in CRE. I want to know what's working, what's actually working.
The usual tools like Yardi, MRI, and Apollo, those are industry tables. But pairing them with Power BI, with other intelligence tools like Flowcast or Avid Exchange, they elevate your reporting and workflow. Dashboards automate variance reviews, and rent roll automation avoids tenant level errors. But tech isn't a magic bullet. If your processes are broken, if you're missing any, or if there are cracks in between those processes, automating them just makes those mistakes bigger.
Yeah, and that is such a great point, Lex, and a perfect way to close the segment. Technology isn't a magic bullet, as you've mentioned, but I think it is a force multiplier. If your foundation is strong, the right technology can create incredible efficiencies and provide those actionable insights you've mentioned earlier. But if the processes are messy, all we're doing is creating a faster, more complicated mess.
Is there a time or can a firm ever be too automated?
Mm, I would say yes, when human judgment is removed. For instance, relying too heavily on autocoding may misclassify CapEx or miss unique lease clauses. Accounting isn't just data processing, no. It's contextual storytelling. Tech should support and not replace critical thinking.
You've hit a such important point, Lex, and I totally agree with you. Technology can be a force multiplier, as I've mentioned a while ago, but it should never replace critical thinking. Relying too much on automation, as you said, can lead to misclassifying capex or missing important list clauses. The human element of judgment and contextual storytelling is what makes the data valuable. It's the difference between just having the numbers and truly understanding the story behind them.
Amazing. I think that's also a great point when it comes to AI. Is there any, or I want to ask how, before we wrap things up, right? I'm inserting these little bits of questions. I want to ask how is AI doing in the CRE industry? Has it become mainstream, or are you just starting to use it right now?
Yeah, thank you for that question, William. Truly, AI is it's been such a buzzword recently, especially especially in the recent years. I would say that AI definitely going to pose challenges for those who aren't ready to adapt it. How we can integrate AI into our workflow is to see it as a positive, something positive, and ensure that we have that mindset that this is also a tool, this is also a tech, which we must use with great care. And additionally, I I agree with what Carl said. He used a very great way to describe it. Is of course that AI is as good as the one who uses that tool.
Yeah, and to add to that, Will and Lex, in the advent of I think as accountants, we need to be adaptive in using technology. We need to leverage every technology that we can use, but ensuring that we follow data privacy policies. And with AI, incorporating it with accounting is actually a tool. It should be viewed as a tool than a threat to the profession. And AI is, we've mentioned, actually an efficient machine that can help us focus on more value adding activities and provide more value with the clients.
Thank you, guys. I think that wraps everything up. From cash flow, capex, to clean reporting, smart automation. Today's episode was short, but is very much packed with value. I want to hear final thoughts from both of you guys.
Well, if there's one thing I've learned, it's that good accounting is invisible until it's not. For real estate, staying ahead of the curve means being proactive, consistent, and strategic with your numbers.
Yeah, and that's, I think, the perfect final thought, Lex. Proactive, consistent, strategic. Good accounting is the invisible engine that drives a successful real estate business. And thank you so much, Lex, for a truly valuable and insightful conversation today.
And thank you as well, Karl, for your valuable information. All right. So if your property financials need a refresh, I think you should visit scrub.net, right, to connect with real estate accounting pros who know CRE inside and out. Again, thank you for buzzing with us on the Beehive Podcast. Until next time, keep your numbers clean and growth intentional.